What's up, everyone? Welcome to RJ Invest. We're here with another video for you. Nick, tell them what we're talking about today.
How to make money when the market is crashing.
That is right. The market is bleeding red right now, and talks of a crash is happening, and everyone is scared. We are going to show you how you can properly invest, properly take these rules that we are going to apply, and still come out on top. You ready?
Mm-hmm.
Let's go.
And it's gay!
What's up, everyone? Welcome back to RJ Invest. Today we are going to show you how you can still invest properly, how you can still maintain your portfolio when the market is crashing and bleeding red. You're going to watch to the end, so don't just skip. All these rules go hand in hand. But before we get started, Nick, tell them what we want you to do.
Make sure you like, subscribe, and hit the notification bell so you don't miss when we upload.
That is right. We are on a mission to turn $1,500 into $15K. If you have not watched our first video, we'll put a link right here, and we want you to click that button right after this video. Do not skip this video because this is important because of the scare that's happening, right? Just a few rules that we need to follow when the market is crashing, if it crashes, and you can still come out on top. We are going to get straight to the video. Nick, tell them what the first rule is.
Not panic sell.
The year is 2008. I'm in my last year serving the Marine Corps, and I think I'm going to get out as a normal civilian in a fruitful economy, and then this happens.
Just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate.
That year, the stock market crashed over 30%. That means if you would have put in $1,000 according to the S&P 500, at the end of that year, you would have had less than $700. Research shows if you would have left that $1,000 in there and it would have went under 7, it would have taken you 4 years to recover if you had just stopped investing. Now, who would do that? I have no idea. Actually, I do have an idea. People who panic sell. That's why rule number 1 is do not panic sell your stocks. All right? It took 4 years to recover if you never put any investment in. However, if you would have continued to apply these rules and then continue to invest like you normally would, it would have taken you on a lot sooner, plus profit. If you look at the chart here, you would see that every year other than 2018, since the stock market crashed in 2008, there has been nothing but gains in the stock market. Even in a market crash, people like us, the retail investors, the 9-to-5ers, we know that when it crashes, it's time for us to invest and catch that U-turn and nothing but gains, and we take it to the moon. Which leads us to the next 2 rules.
Save cash and dollar cost average in.
These rules go hand in hand because without saving cash, you cannot dollar cost average in. What you want to do is save your cash while the market continues to go down further and further. With that, you're going to dollar cost average in with that cash with the stocks that you are already invested in. What is dollar cost average in? Nick is going to explain it to you.
Dollar cost averaging is periodically investing a set amount of money regardless of the market price of the securities being purchased.
Investing in companies that you believe in, when the market is crashing, you would not panic sell. You would DCA in, because what he's explaining in simple terms is whether it's up or down, if you're setting up your recurring payments and every time you're setting up your recurring investments, it will average out to the real cost of that stock. For example,
this chart shows an example of DCA. The red dot represents every recurring investment made on a stock no matter the price. You will see the solid orange line that represents the stock's average cost. So you see, if you purchased on a stock's high or low with the DCA method, you average out.
You ever seen the meme where it goes a dip within the dip within the dip, and a stock market crash? That will happen. So I use the DCA method and I put my own little twist in it, and I have a 10% rule method. I stop the purchases of all new stocks, and as I try to DCA in during the stock market crash, anything that goes below 10%, I then purchase those stocks to DCA. This is not financial advice, but if it was me, after I have DCA all of my stocks and my growth stocks and I dollar cost average down, I would then do the next step.
Buy the dip.
Buy the dip. This is the fun part. This is when you get to take all that cash you saved in and look at all the stocks that you've wanted, all the Apple stock, all the Amazon, all the Tesla stock, everything that you wanted and you can buy in. Me personally, this is not financial advice, but I will look at dividends and ETFs and I would just load the boat on it. If you do not know what ETFs are or dividends, they're going to make you money whether the stock's going up or down because you're going to get a percentage and profit off these companies. We're going to do another video coming up about dividends and ETFs and the difference between the two, which leads us to our last but not least rule.
Get out of margin.
Get out of margin. If you don't know what margin is, that's good for you. That means you're not borrowing money. A margin is when the brokerage will match you with your cash value of your portfolio and allow you to will and deal and make profits with their money, and they will charge you a percentage. This is owing money. This is borrowing money. The last thing that you want to do when the market is crashing is have margin call. That means you're going to be forced to sell all your stocks off and you're not going to get any gains. We do not want margin calls, all right? This is the last rule, but this is probably the first thing that you should be doing to prep yourself for a market crash. None of us know if the market crash is really going to happen. If it does happen, when it's going to happen, no one can time the market correctly. I don't care who you are, how much money you have invested, any experience. No one knows if and when a crash is going to happen. However, it is better to be proactive versus being reactive. All right. This is not financial advice. These are just the rules that we live by to continue to make gains while we're investing. If you guys do something else or apply different rules than what we discussed today, I want you to leave a comment. All right. We're going to do another video. Next video is going to be about dividends and ETFs. Till then, I want you to ask all the questions. We're going to answer them. We're on a road to generational wealth. Nick, tell them what they need to do.
You need to like, subscribe, and hit the bell so you don't miss a video when we do upload.
That's right, my boy. We will see you next time.